Good morning, guys. How's it going? Well? Very well, very well. So I'm going to start today with a story. I think stories are nice. People relate to stories and you follow an arc, right? And this story is a personal one. It relates to a meeting I had probably 2017 with a very prominent asset management company in London. I'll set the scene for you before I go into it. So this was 2017. A lot of things were happening in the world then. You know, Trump was elected, Macron was elected, beat Le Pen. Xi Jinping gave a very important speech at Davos. Mosul was captured by ISIS. A lot of international things. So I was brought in to really discuss these topics with this firm, speaking with their chief investment officer. So in the meeting, we sat down, central London, very swanky, as you can imagine. And we had a conversation about how they engage with emerging markets. They invest heavily in emerging markets, and they were curious as to our approach. But I was, at the same time, curious to their approach, see how they actually go about analyzing these markets and making investment decisions. And since they invest in emerging markets, I asked them, who conducts your geopolitical risk analysis? Given the fact that there's a lot more volatility in emerging markets for stuff like this. And he turned around to me and said, "Oh, Klisman, we don't do geopolitical risk analysis." I said, "Oh, why?" He said, "We read the FT." I said, "Okay." My jaw dropped at that moment. I had to clean it up because it was a shocking statement, as you can imagine. And I left that meeting, obviously, quite shocked. And I'd say probably a little offended, not to myself, but at the investors whose money was placed in their care to invest in the long-term future. And I thought to myself, this experience I've heard before by different people, be they governments at some points, corporations of different calibers. And I thought there must be a reason as to why there's such short-term thinking and such shallow thinking when it comes time to these very important issues. So as it relates to the SDG goals, it's curious because we have a system in place now where we need to think long-term. We have these goals which are over 30 years, right? From the Millennium Development Goals, as we can remember, their past history now, to now these new goals, which hopefully, as an international community, we'll do something about. But we tend to think in very short-term time cycles. And I thought long-term issues, short-term time cycles is a big gap in making plans for the future. So I thought with the organization that we founded, Pareto Economics, we needed to think long-term. So we needed to start with a very long-term question, a statement which really encapsulates what we're trying to do. How do I go next? This isn't working. Anyway, well, there we go. Okay, fantastic, now it works. So the question that we're trying to answer and encapsulate is the following. How will the world be changed and challenged over the next 100 years? And to an extent, everyone in this room and everyone watching online and everyone who gets to hear this talk really is trying to answer a derivative of this question in their own capacity, right? How is this country going to develop over this investment period? Should I invest here? What are the risks of investing there, right? And if we have these short-term time cycles, then we'll never come up with long-term strategy. And that's the thing that's plaguing, I think, the achievement of these millennium, Freudian slip, these sustainable development goals. So in order to answer this question, you need to really begin at a very core place. You need to really have some core assumptions that you make about the world, which will allow you to think long-term, okay? So for our starting point, we really have 3 core assumptions that we make about the world, which we use in our analysis, which then we can provide effective consulting and research to our clients, okay? So our first assumption, and I'm going to move about a bit if that's okay with you. Our first assumption is that the nation state or a country is the primary driver of world affairs, right? It's a very realist way of looking at the world, very Kissinger-esque, I suppose. And this can be proven. We have, if you think about it, people are citizens of countries, wars happen between countries, countries pass legislation, tariffs are placed at the borders of countries, international organizations, for example, are allowed to exist by countries to serve countries, and corporations can thrive or suffer by one stroke of the legislative pen. So that's our first assumption, that if you're going to look at how the world develops, especially as an investor, as a corporation, or as a country representative, you need to look at the world through a country lens. The next assumption is try to understand what do countries want. And in our estimations, countries want power, right? And when we speak to country representatives about this, they have a very sort of a somber look about them because they know that's what it is, but it's hard to define a lot of the time. So how do we define power in this context? And in our estimation, power isn't the ability of one country to force the other to do what it wants, right? But rather, power is the ability of a country to secure their own interests. Okay, I'll say it again. It's the ability of a country to secure their own interests. Now, this isn't in a binary expression. It's not a case that some are able and some aren't able. It's more on a continuum, all right? So the next question became for us, how does a country go about securing their own interests? What do they have at their disposal to do so? And this is where we've developed something called the centers of power model. Now, I'm not going to get too technical. This is a very simple graph, and this forms the essence of the work that we do and why it's important to this room, and we'll get into it. So what we're saying is that each country has at their capacity these what we call 6 centers of power, which they can use to secure their own interests, right? Their active consumer markets, their military balances, their technological leadership, their systemically important commodities, geostrategic positioning, and their financial strength. So when a new country is introduced into the world, like for example South Sudan or Kosovo, for example, they automatically adopt these 6 centers of powers depending on their region, on their geographic borders, and what they have within them, and the capacity in there. So then what we did is that we quantified these 6 measures, and we've ranked 194 countries against them in order to find out how much of an ability do these countries have to secure their own interests through these models. And then what we did in the middle of the Global Power Index, we essentially added all of these sub-indices up, and we created a super index called the Global Power Index, right? In order to measure the power of countries or the ability to secure their own interests. So power, in fact, isn't sort of a metric which you use to gauge how much violent a country can be against another, but rather power is a unit of measurement. Just like millimeters, miles, hectares, or light years, power is a unit of measurement which measures the ability of a country to secure their own interests. So we try to quantify this as much as possible. And this measure ranks from 0 to moderate power to 600, which is exceptional power. So what I'm about to show you on the next slide is how the world ranks, or at least the top 90 countries. If you want the full report, you can speak to myself afterwards and we can email it to you or go into our website. But what you're about to see is the top 90 countries in our Global Power Index, okay? Before that, we break the world down into 7 regions. This is how the world is segmented by us. Different regions there, you can read them: North, South America, Europe, Asia Pacific, etc. And then what we've done is across the regions, we have the regions there, and then we have the indices across the vertical too. So what we're going to be looking at is the one in blue, the GPI all, where we'll be looking at all the countries in the GPI, but for this case, the top 90. So are you ready to see what the world looks like? Have you got any estimations in your mind as to who would rank first, second, third? I'm sure you do. But the results might shock you. I'll leave that up for you for a second to read. And whilst you're looking at that, I'll explain what the colors mean. So the ones in yellow show that there's been no movement from last year to this year, okay? The colors in green show an uptick in ranking. The colors in red show a downturn in ranking. And the blue colors show new countries which have been added to the index from last year onto this year. So this is what the world looks like, and this is how we see from our analysis the world shaping up, okay? And we can go into asking questions as to why this is there, why that's like that. But this essentially is a collection of the sub-indices added together to show a holistic view on how the world looks like. Again, we have until 194, but this is what we have just for ease sake. Some notable examples: for example, South Africa at 58, we have Finland at 26, Italy at 13, Morocco at 78, Gabon at 87, Kuwait at 89, US number 1, China 2, France 3, Singapore 4, UK 5. Top 5 are there. So some highlights from this year's index, at least, we see the following. The Netherlands ranked as the highest newcomer to the index from last year. The lowest ranked newcomer is North Korea. And in fact, they ranked the lowest at 194 in the world for the ability to secure their own interests. Europe ranks as the highest performing region, and Sub-Saharan Africa ranks as the lowest performing region. Again, the in-between ones can be accessed through our report, but these are just some highlights for you guys to understand. So when it comes time to the SDG goals, what this index can help you do is to see at what level and at what capacity are these countries to take on responsibility and to innovate further for these, and also to look at unrealized potential to invest in specific countries, which have, although being low, doesn't mean they're there and they'll stay there, but they have the biggest upswing possible. So it's not to say that the countries which are ranked the highest doesn't mean they'll be there for forever. It could mean that they've reached their pinnacle. Countries which are ranked slightly lower have the ability to move up based on proper policies, leadership, good investment strategies, etc. So this gives you a view of this. So I'm not going to show you all of these, but this is something that we've created as well called the volatility change in countries, which means from last year to this year, how much movement within each region have countries moved up or down. So I'm only going to be showing Europe and Sub-Saharan Africa. If you want all the regions, again, we have the report. So if you look at Europe, the least volatile countries, France, Germany, and the United Kingdom, which haven't moved much, up or down one place. Whereas Bulgaria, Serbia, and Romania have moved quite a lot, minus 18 to minus 15 places down. So this shows you from last year to this year what has happened in the world. And this is a starting point to investigate why are these changes occurring, and if you're an investor, to find out what you can do about it, if it impacts you. If you're a country which wants to partner with one of these countries, why is this the case? Is there anything we should know about this country moving forward that we haven't analyzed already? To have a universal view, a 360-degree view of a country's potential and where it's going into the future. Sub-Saharan Africa, this is the way that it looks. So Nigeria, Botswana, and South Africa, the least movements. So Nigeria hasn't moved at all from last year. And again, +1 movement up for Botswana and +2 movement up for South Africa. Zimbabwe has moved down -35, Mali -23, and the CAR -29. Okay, so this is just some highlights to the figures. Happy to take questions and answers afterwards, but this is what the world looks like as it stands. And in summary, what we can understand is when looking towards the SDG goals and what it means for countries as they develop in them, there are certain things that happen with countries when they become more powerful and when they slip down in power. So as you can imagine, this is very organic. Just like plants being planted in the right soil, they grow at different paces, and sometimes there's competition which sucks up their soil and sucks up their nutrients, and they go down. So in real terms, there are a few things that we've noticed that happen in the world for countries when they gain the ability to secure their own interests, and what happens when they lose the ability to secure their own interests. So these are just some of the highlights, and we've conducted extensive reports across many different countries on this. So one of the things is that they become more attractive to international trading blocs. So if you look at, for example, a thing like BRICS, which has taken 20-odd years to become important from 2001, we see countries now like Argentina, Mexico, and others wanting to join and having the attractiveness to join because overall they are in a place where they can offer more to the bloc than they take away. Okay? Also, when it comes time to trade barriers, what we see historically, trade and tariff and non-tariff barriers go up as countries become more prominent because they now have industries within their countries, domestic industries that they want to protect and grow and develop skill sets for. So the ability to trade with them or to sell into these markets becomes restricted. We see this, for example, with the United States, which is still quite protectionist, China also growing to be still very protectionist, and others across time, because they want to keep what they have of value and they want to create and they want to cultivate strength within their own economies. They tend to think over a much longer term period. If you have countries which are stagnating, high levels of corruption, weak institutions, they are the ones who think very short term. But again, if you are stable, if you're growing, your time increments aren't every election cycle, but hopefully they're every 10, 20 years, depending on what vision you have for the country and how much buy-in you have from the public. On the other side, if you're weak, you're thinking in very short-term time cycles because you're not interested in what the country looks like over a long period of time because there's political volatility happening in your region and your country, and the incentives are different. They're also able to leverage what I mentioned before, their COPs or their centers of power much more so. So when it comes time to debating or to negotiating at the trade table, at the WTO, for example, they're able to leverage their centers of power and gain more at the negotiating table because they have more to work with. A fantastic case study is a country like Saudi Arabia. Back in the 20s, it was a fledgling country. It was sort of not as powerful as today at all. As oil was discovered and taken advantage of, they developed their industries, and now they're a very prominent power in the world, and definitely regionally, because they're able to develop these things. So for country leaders in this room, and for investors in this room, it's very important to see the trajectory of countries through a lens which is quantitative and which is long-term. Because we know what the alternative looks like. And no one wants to be here in 5 more years saying we rely on the FT, although they are a very good publication, but to rely on long-term investment trends, on just short, I would say at some points profane and shallow analysis that you can't really base your investment strategy upon. You can use that as a starting point. You need much more longer-term thinking. So this is what I want to impart on you today, and to have you thinking more long-term when you're looking into your investment strategies and what to look at when making these investment decisions. Thank you very much.
So, Klisman, I'd like to hear your thoughts around that.
So if I had another 10 minutes on stage, I would have continued my thought process. But I'm going to do that here in probably 2 minutes. So we have to understand that trade, number one, is a means to an end. Because countries, as they grow and as they develop, trade is one of the phenomenon that develops as your population grows, and as your intellectual property grows, and as your human capital grows.
Yeah.
And it's a two-way street where you need to educate and develop infrastructure and the ability for your people to prosper, and you need to export that to markets that need it, and you need to import goods for you to sustain your own growth. So if I were to continue my thought process from before, what I would say is that as countries grow and lose power over their 6 centers of power, what we see developing in the world are 4 major themes that emerge, what we call the global 4. And these include globalization becomes more important. Despite what the naysayers say today, it's still very, very important. Geopolitics becomes ever more present in the world, because as countries grow their power, they have a larger voice in the world, and now they can do things that they couldn't do before, right? Next thing that develops is technological transformation in different industries. As, again, IP grows and as scale of technology grows through software and hardware, that becomes a stake in the country's development. And everyone wants to own IP and own the means to develop IP, okay? And the fourth thing that develops is societal change. Demographic shifts change and evolve. Perspectives on how we should live our lives change and evolve, which then impacts businesses who need to then serve these markets with these ideas. And these things are converging, right? Meaning they are happening at the same time across different parts of the world. But the impacts of that are very, very distinct, depending on where these impacts are felt. So for a government that is looking to grow and to engage with the private sector, what they need to do, and what we say to them all the time, is that you need to develop an identity for yourself as how do you see yourself going into the future? What are the strengths that you want to develop? Because you can't develop them all. You have only limited time in office, and you have limited financial resources, political capital, etc., to then invest into the projects you want to invest in. So you need to be very clear as a government what it is that you want to see achieved over your lifespan in office. And once you have that as concretely as possible, then you engage with whoever it is you need to engage with to make these things happen. And it's a slow process, and it's an arduous process, but through different organizations and through collaborations, through international organizations, Chamber of Commerce's, of course, you're able to do this. It is slow, it is arduous, but it's worthwhile to set in motion at the very beginning what it is you want to do as a country, what you want to be known for, and what are going to be the barriers in your way, and to prepare for them as early as possible by having a sense of where are my competitors going and where are my collaborators going into the future, so you can form relations with countries which you wouldn't have thought would be valuable, but once you look at the world again through sort of the centers of power model, you can see very clearly over the next 30, 40 years, where are these countries going, and should we be developing relationships with them now so that they can foster great things into the future?
All right, that's quite brilliant.
Favor of the SDGs that give a different, completely different overview of your model.
Well, to understand that, I haven't had the chance to go into it, but they are below each sub-index. There are themes within that reflect issues which impact the SDGs. So you have to think about the index as like a gym. Okay, you have the equipment there, but you need to use it. You need to have an aim, right? And the data behind that can be contorted to reflect the questions that you want to be answered. So when you're looking at, for example, the Netherlands and its development plans, no matter what it is, right? Because again, what will be the future of the Netherlands over the next 100 years is a derivative, right, of the macro question that we asked, and any other smaller question like that. The SDGs is part of it for sure. So if you're looking at answering these questions, it's very clear to start from a place of what exactly is it that I want to understand. Because you run the risk of asking a bigger question, which can be broken down into smaller ones. Which is why I don't agree with the concept of ESG, because they're three very distinct things. And when you put them under one umbrella, having any measure of ESG, company rankings become very contorted. You can have 10 different measures of ESG, and they'll have 10 different rankings of countries. So that's unhelpful. The more specific you are with what you want to know, the more effective this index is to help you answer that. But yes, there are metrics that we use which best reflect how capable countries are to achieving their aims. And if their aims are the SDGs, that's just a target. What we measure is the ability to get there. So for example, if you want to train for the London Marathon, right, that's like the SDG target. What we do is see what you have at your disposal to get you there. Have you got a personal trainer, right? Do you have the right equipment, right? How often do you train, right? These are the things which then tell us you have a 10%, 50% likelihood of coming first, second, third, fourth in that race. So that's how it works.
Do any of the other panelists have anything to add to that?
It is interesting, though, all these different tables. And I've used the ease of doing business, which is a personal favourite, which is actually correlates a little bit with your table, but not precisely. And the United Kingdom is in the top 10 in both, which is really good. But I don't know whether there's a kind of a global index of global indexes, is there?
I don't think so, no. I don't think so.
Maybe we can create one today.
Well, something like that, you'll never get any answer, because if you measure everything, you're really measuring nothing.
Yeah.
You know, so the more precise you are, the better the measure is. Yeah. That's what we've understood.
Yeah. Oh, right.
And I just sitting on that for a moment with the global index, I wonder how, given our topic is sustainable finance right now, how that will impact decision making within organisations. You know, having worked in currency for many years at the moment, that really affects how we trade with different regions around the world, because the currency pairing and based on the risk in locations. What are you predicting that this tool's going to, how is it going to influence the finance sector?
The finance sector, well, you have to understand that we have the financial strength sub-index, which does a very good job in having a pulse on fiscal and monetary policy. So again, it depends on who you are and what question you're asking. So if you're asking from the perspective of a business, right, that trades grain, right, or wheat, right, your perspective on what those markets are going to do would depend on what question you're asking, okay? If you're a government and your main concern maybe isn't the SDGs right now because you have an unemployment crisis that hasn't been seen before. Let's say you're Lebanon, for example. Lebanon is in a place that hasn't been before, right? So their main immediate sort of tasks are not as macro, right, and as sort of long term. But what we can do with this index is that we can see what are the fundamentals of Lebanon or the Czech Republic, for example, and given where the Czech Republic wants to go into the future, what number one it needs to do to get there that they may not be considering, and what partnerships they can build now so that can help them get there from a country perspective. And investors looking at that, you work with investors by saying, this is where this country wants to go into the future. These are the partnerships that it wants to develop, and this is where you can play your place. This is where you can play your place to grow with them. So it gives you a map for you to make more long. Again, it's always about the long term, because it's very easy to think short term. You get scared, you think short term, you know. But it's the long term that really matters. That's what keeps the economy is thriving and driving into the future.
I think one of the most interesting things about your index was tying into what I was saying about real world impacts, because I can see government from a policy perspective looking at your index and the point you made about therefore we are going to be able to do better trade deals because we have this power. That's an example of a real world impact that you can explain to people and say, we need to increase our defence spending because that will in turn lead to greater trade deals internationally that will reduce the price of bread in the supermarket. So I think these things are connected, but I guess my beef, and I'm sorry to sound cynical, but my beef is I don't think we're good at explaining them and making real world connectivity between the kind of things we're talking about and that people actually at home are understanding.
James.
No, thank you, Katie. I think to build on that discussion, there's no accident from what we saw from the presentation before that the Netherlands was said to be number one, and North Korea was at the bottom of the table. I think we all know, in terms of North Korea, it is a society that is enclosed. It is a society that is not outward looking, while countries such as the Netherlands have always been outward looking for many, many years and has taken a very progressive approach under successive governments, actually, in the Netherlands going forward. But I think what's important about the indexes that we're discussing today is that they're a tool. They're not an end in itself, as we've just heard.
Yes.
And so as part of that, in terms of the challenge that you've just, the question that you've just asked us, Katie, in terms of sustainable finance, we need to look at different ways of sustainable finance. So here in London, for example, we're looking at Sukuks, which are Islamic finance bonds, which focuses on long-term patient capital, long-term finance, in other words.
Yeah.
We're looking at policy performance bonds, which is a derivation, a kind of a variation of conventional bonds, for want of a better term, which looks at paying investors after key policy objectives, which are measurable, are achieved. So I think these are the kind of initiatives that need to carry on, because as we've heard from Rupert, if we just carry on with business as usual, we're going to get the same result, which is why I think everybody on this panel is urging a new approach. But that also means embracing new forms of patient finance or long-term finance, which hasn't always been flavour of the month in financial centres around the world.
My question, though, is this two-pronged. I look at the SDGs, I don't know a great deal about them. It's the United Nations one. How united is United Nations with these SDGs? Is what is happening in the Far East different from what is happening in the West? Is there convergence? I don't know, and I'm asking that as a question, because that world is further, is 30 years ahead of us in the West. And I just wondered about that.
Thank you for your question. Would anyone like to take the response?
Well, the SDGs are not a new innovation. So to give you a whistle-stop tour of what the history of this. Again, these SDGs came up 15 years ago as the Millennium Development Goals, and even before that in different iterations, to respond to global challenges that all countries face, from the ground level up to the corporate and political level. So again, as a UN initiative, it was something which was developed off the back of the UN, because that is the body that represents countries naturally across the world, to develop some sort of standards and some sort of goals which we can all broadly agree to move towards. Yeah? It's not a legally binding document. There's nothing saying that you have to do this, but there are sets of principles and goals that all countries and all corporations that are helping countries develop this are trying to work together, right? So we have education, we have issues in relation to corruption, we have issues in relation to clean water, right, and others, fair business and others, which emerged over many years of consultations with governments and with the civil societies. And they came up with these goals, and they had a target of 15 years to reach some sort of targets. And then they got reinvented as the SDGs for a further 15 years. So I think the plan for this is to continue to grow them and to evolve them and to engage governments at different levels to move towards this for the macro benefit of us all. Now, how each country does them is a different story, as we know. Again, there is a realistic perspective, but at least we have done as a human race, we've developed an institution, and I think we need to realize how much we've moved forward. Although we do have a lot of negatives in the world, the fact that we managed to develop a consortium of countries which come together at the negotiating table, yeah, to make sure that we don't blow ourselves into pieces, and so far we've done a relatively good job at it so far. And beyond that, hopefully we can, into the future, develop some sort of standards and goals that benefit everyone. So countries will develop at their rate, depending on how willing they are to reach these targets. Naturally, there's debates between countries as to what their target should be, as we see with climate change. But at least we have a common goal, and we're trying our best to move towards that. That's just a sort of more broader vision of what the SDGs are.
Further thoughts?
Okay.
Yeah, I think one of the most important comments you made there was about people working at agreeing the goals, but then implementing them at different rates, because it's the different rates that undermines the goals. Because this goes back to my cynicism point about what is the point of the UK busting itself to go to net zero where China is still building coal-powered power stations. Now, we could say it's virtue signalling, that we're leading by example. We could say that our 2% makes a big difference in the big scheme of things. Or, like a lot of people, we could be cynical and say, what's the point?
Yeah.
So it's the goals have to be driven, the outcomes have to be driven in tandem. Now, one way of doing this, which was a slide that I mentioned about ease of doing business, because ease of doing business is actually a remarkably efficient market mechanism for making countries meet the goals in a consistent manner. Because if you're bad at encouraging business, however you want to define that, and you could build in sustainable development goals into those criteria, you won't get any foreign direct investment. If you don't get any foreign direct investment, your country and your people are going to be poorer. So one of the ways of explaining it is to say we need to behave or meet these sustainable goals consistently in order to be in a level playing field with our competitive countries about how they do that. And it really can work, because I think one of the remarkable things about Africa, I don't know Africa that well, but is, for example, how Africa has completely missed out on, has gone straight to mobile telephony and missed out on the whole landline thing by, I don't know, by accident or just by timing. But it shows that actually you can catch up incredibly quickly if you get the right mix of investment and a will from the people.
And just to add to that, I think it's very important as well promoting partnerships, which is at the back of the SDGs, and what the London Chamber is doing is quite remarkable in terms of that partnership with the African Union, which I think is really interesting with respect to the African Free Trade Agreement. And in fact, the African Free Trade Agreement is an open area of opportunities and partnerships, and I think at the back of the SDG is really promoting that space. I will say we'll encourage more partnerships, engagements in that global front, and this is quite really brilliant, and I must applaud that.
Thank you.
Yeah.
Thank you, Patricia. And look, on that note, I will close off the panel discussion. We've got a small break now to the next session, which is going to be 15 minutes. So James, Klisman, Patricia, Rupert, Michaela, thank you very much for all of your insights today. Big round of applause, everybody.